In today's video presentation, I am your host, Luando Franklin, the lead tutor, Chief Executive Officer, and pioneer of SEO Accountants Tuition Center. Before I get started, I want to encourage our viewers to ask questions on the related question in today's presentation in the chat box, so the questions will be attended to depending on the availability of time. I also want to encourage our viewers to make comments in the comment section about the quality of this video. All the comments made will be used to improve our delivery. In today's video, I'm going to explain the process when a company diversifies into another type of business. If that happens, then the current weighted average cost of capital cannot be used to evaluate that project because the risks are different. Therefore, the company should identify the proxy company. A proxy company is a company in the same type of business. If the proxy company is only doing some component, not all components of the new project, then the company should also identify the industry which has the other components of the project. Thereafter, the equity beta of a proxy company should be de-geared. De-gearing simply means removing the level of gearing. Also, the equity beta of the industry doing the other components should also be de-geared. And then find the average beta for the two sectors, that is the proxy company and the industry. After determining the average asset beta, you can now gear up to the level of borrowing of the company in question. Thereafter, the cost of equity can be determined. And the weighted average cost of capital can be calculated, which will now be used to evaluate the project at hand. So those are the processes. Now, let's look at this question together. Mercury Training was established in 2009, and since that time, it had developed rapidly. The directors are considering either a flotation or an outright sale of the company. The company provides training for companies in the computer and telecommunications sectors. It offers a variety of courses, ranging from short, intensive courses in office software to high-level risk management courses using advanced modeling techniques. Mercury employs a number of in-house experts who provide technical materials and other support for the teams that service individual client requirements. In recent years, Mercury has diversified, so it has gone into a different type of business, into financial services sector, which is totally different, and now also provides computer simulation systems for companies for value acquisition. This business now accounts for 1/3. So they are the 1/3 of the company's total revenue is important. So we can now go to the other parts of the question. Mercury currently has 10,005,50 shares in issue. Jupiter is one of the few competitors. So that competitor is a proxy company in Mercury's line of business. However, Jupiter is only involved in the training. So the proxy does not offer the financial services. It is only involved in training. Therefore, you need to find an industry which also provides financial services. Jupiter is listed on a small company investment market and has an estimated beta of 1.5. Jupiter has 50 million shares in issue with a market price of 580 cents. The average beta for the financial service sector, so now we find another one which is doing the financial services, 0.9. The average beta for financial services sector is 0.9. Average market gearing, debt to total equity, debt to total market value in the financial service sector is estimated at 25%. Other company statistics for both companies for the year ended 31st December 2020 are as follows. So we have for Mercury, the company in question, or the company under review. It has earnings per share, net assets, dividends, gearing debt to total market value 30%, Jupiter 12%, given 5-year historical earnings growth 12%, 8%. Analysts forecast revenue growth in the training sector business to be 6% per annum, but the financial service sector is expected to grow at just 4%. The equity risk premium is 3.5%, and the rate of return on short-dated government stock is 4.5%. Both companies can raise debt at 2.5% above the risk premium. Tax on corporate profits is 40%. Now, this is very important. Where the cost of debt is not given, it can be found. Where the cost of debt is not given, it can be found here. In this case, the cost of debt will be risk-free plus they can borrow above risk-free 2.5. So interest above. Interest above risk-free. In this case, we have risk-free, which is 4.5, plus interest above risk-free, we are told it is 2.5. So the cost of debt, in this case, it will be 7%. Good. So now, let's follow the process. So we go to the proxy. The proxy company is Jupiter. For Jupiter, we can degear. To degear is to remove the gearing level. Degear. The formula for degearing is beta of ungeared company, that's what we want to arrive at. Beta of ungeared company is also referred to as asset beta, is equal to equity beta or beta of a geared company multiplied by value of equity divided by value of equity plus value of debt 1 minus T. Now, for Jupiter, we have debt to equity. So this is debt percentage as a proportion, which means the balance is equity, which will be 12 from 100. It will be 88. And we are given the estimated beta, which is geared beta 1.5 multiplied by proportion 88 divided by 88 plus 12, 1 minus 40, 0.4. So here we have roughly 1.3865. This is the asset beta for the proxy. We have removed the level of its gearing. Now we are remaining with the asset beta or beta of ungeared company. Now we go to financial services. Financial services. The financial services here we have, it has 9%. So it has 0.9 as the beta of a geared company there. And the debt to equity debt is 25% and 75% will be equity. So there it will be is equal to 0.9 multiplied by 75 equity (25) 1 minus 0.4. So here we have the asset beta of 0.75. After we find that, we can now find the average. We go to the average. Average asset beta. That will be used now for Mercury, because these now they involve both components of the services that will be required when they diversify. So now we go to part 3. Part 3 there. Average. Average beta for Mercury. Average beta for Mercury. We have, for financial services, we are told it is 1/3. So if it is 1/3, then for Jupiter, it will be 2/3. So this will be 2/3, that is 0.67. multiply by the asset beta for Jupiter plus 1/3 is 0.33 for financial services. This will give us 1.175. That is the average beta for now Mercury, because now it considers both types of services offered. Then now, regear. To regear now is to consider the gearing level for Mercury. Mercury, we have 30% debt, 70% will be equity. So when you gear up, regear is also known as gearing up. To gear up is to include the level of borrowing. So it will be, that's the formula. One minus T divided by equity. That is the formula for gearing up. So we have the asset beta. Asset beta is the beta of an geared company. Therefore, now we need to put our level of gearing. So there, 30% is debt, 70 will be equity. Divide by 70. So this will give us 1.48. That is the equity beta for Mercury according to its level of borrowing. So we can use that now to calculate the cost of equity. Cost of equity is equal to interest from risk-free. This is now equity beta, which is beta of a geared company, multiply by, or bracket, risk-free, minus the return from the market as a whole. Risk-free, we have 4.5. $1.48. Equity risk premium, they have already found the difference between RF and RM. 3.5. And this will give us 9.68%. So thereafter now we can calculate the equity, sorry, the weighted average cost of capital. The weighted average cost of capital here will be, we can use this part, WACC. WACC is equal to cost of equity multiplied by the proportion plus cost of debt 1 minus T multiplied by the proportion. So here the cost of debt, we have the cost of equity 9.68 multiplied by the proportion of equity. The proportion of equity is 70, 0.7 plus the cost of debt, we had calculated it was 7 multiplied by 0.6 multiplied by the proportion, which is 30, 0. This gives us 8.04%. So we have answered, we are looking just at part A, estimate the cost of equity, capital, and the weighted average cost of capital for training. So we have done that, and that's the part of the question that we are looking at. So for today, we can end here. And remember, for the new subscribers, to hit the notification button so that you are able to receive the latest videos when they are available. On behalf of FCO Accountants Tuition Center, I want to thank you all for your support, both the new subscribers and the existing. We are grateful for the support that you are giving us. May the Almighty God Jehovah bless you beyond measure.